You know, you've got people paying 20% over the price of the house, right? They're not worried about their monthly payment. They're worried about the appraisal.
Yeah.
Why are they worried about the appraisal? Because
it's not worth it.
now if it doesn't appraise, people have a much harder time coming up with cash than they do their payment going up $100 a month. And that's the barrier to entry for a lot of people in this crazy market.
This is Laricy Live, and I'm your host, Matt Laricy, giving you unfiltered access to the world of real estate. We cover market trends, news, and give you the honest answers that will keep you ahead of the real estate game. Okay, so today we have special guest appearance, the biggest lender in Illinois. Are you the biggest lender in the country now, or are you still number two?
I'm still number two. Thank you very much.
Number two. So second biggest lender in the country. So with the first guy called in sick.
Yeah.
So Ben Cohen's with Guaranteed Rate. Ben, how long you been in the mortgage business for?
17 years.
17 years strong. That's about how long as I've been in real estate, except you're way more successful than me, so that's depressing. But you were on this about a year ago, right?
Yes, sir.
And we're trying to talk about what is probably one of the hottest topics in real estate today, which is the rates are going up, they're rising, and it's been a big talk. Yeah. I keep telling people I don't really think it's that big of a deal, but I don't want to just hear it from myself. We want to hear it from one of the biggest lenders in the world and get their take on it. And Ben, maybe you could kind of just give us like maybe a dummy level education of like what is an interest rate? Like how does it work?
How does an interest rate work? Well, you take your purchase price.
Yeah.
You buy a home for $500,000. Yeah. You put $100,000 down, which is 20%. You finance $400,000.
Yeah.
You figure out what your rate is, and that determines what your monthly payment is.
And do you think like interest rates have a huge impact on the market itself?
Psychologically, yes. Economically, no.
Yeah, I mean, we were saying before the shot that the average interest rate in America was about 7%.
Yeah.
So that's average, which means that where are they at right now? What's going rate like today?
This minute, this hour, what are you talking about?
I mean, just like roughly in the last couple of days.
375, 3875.
Okay, and like, I mean, I know that when I got in the business, I would actually always write because we just had a template in the contract. And even when I was in college, I would go in the office and fill out contracts for my old man. I put 6.5%.
Yeah.
That's what we did. Mm-hmm. For like ever until the bubble hit. Mm-hmm. And I think they got around like 5, right? Mm-hmm. And then people were like going crazy. And then when they got to 4, people were like, wow. Did you ever think they would go below 4?
No. I mean, when I started selling mortgages back in 2004, I remember we were quoting rates at 7.5%, 8.5%.
Yeah.
And I have vivid memories of when rates went from 7 to 6, 6 to 5, 5 to 4, 4 to 3. I mean, you remember those days, basically.
Right. And I don't even know. Like, I don't know how much money I would have put on the table if you would tell me they would have got below 3 at some point. I mean, I probably would have put my chips in. I would have put my life savings in, saying I didn't think it would happen. It happened. And now that they're at 3.75-ish, let's call it, roughly. I mean, that's still like a ridiculously low rate. Am I wrong?
You are not.
Even like 4.25 is not a bad rate.
I personally think that anything under 5%, when you talk about historically, we're doing pretty well.
So, like, what would you think is like a realistic rate? Like, let's take these last few years out of it. Like, would you say 5 is just like probably like a good rate then normally?
Sure, but I would probably say, 4, mid-4s, 4.5.
Okay.
The Fed was projecting rates to kind of get to 4% by the end of 2022, and you saw that happen in the first 2 months of the year.
Yeah.
So,
what do you think causes these rates to go up and down?
Inflation.
Inflation's going on? So inflation has a big impact on the market.
Inflation has a huge impact. I mean, I tell everybody, like, what isn't more expensive out there?
Yeah.
Whether you're buying a car, you're building a home,
you're
buying milk at the grocery store. I mean, everything is more expensive.
Yeah.
So, I mean, jobs report, what the Fed is talking about doing. I mean, the Fed has been artificially keeping interest rates so low over the last couple of years, people have lost their sense of reality on what a good rate is and what a good rate isn't.
Do you think that the Feds did that to try to pump up the housing market because of the pandemic and like
sure
it was a thing that was kind of like helping the economy out?
Sure, and just help stimulate the economy. I think there's a lot of reasons why they did what they did.
I keep saying like the rates have to go up because I mean we're printing money.
Yeah.
That creates inflation.
Correct.
And that the government's essentially broke because these trillion upon trillion dollar policies that went out, like at some point we got to pay that bill.
Somebody's got to pay for it.
So rates is a big way that they try to help make up that money. So when you're trading at, 2.9% interest rate, and I got, like 22-year-old kids call me up, be like, wow, I can't believe my rate's at 3%. That's so expensive.
Correct.
What do you say to that? What do you say to when somebody's like 3% sounds high?
I talk to them about historical data, just like what we talked about earlier.
Yeah.
And I always try to focus on payment and not an interest rate.
Yeah.
Obviously, an interest rate is important to a consumer, but at the end of the day, one thing I always tell a customer is when you buy your house and you close on your home, similar to a car.
Yeah.
Do you remember what your payment is, or do you remember what your interest rate is?
Right.
Most people are going to say your payment. Can you tell me your rate on your car payment? Probably. Or on your car loan? Probably not. Can you tell me your payment?
Yeah.
Maybe you can, maybe you can't.
I don't look.
Yeah.
But
All right. Well,
just it's
you're
like one
special.
of the, like for me, like it's better just not to know.
Correct.
Like just the money's being auto debited out there, unless I miss like an auto debit, like I don't care.
Yeah, I mean, listen, it's interesting because being in the business, I'm desensitized to rate.
Right.
I'm payment focused.
Yeah.
I look at my own loan. I refinance my mortgage. At the end of the day, obviously the rate is important because that determines your payment.
Yeah.
But I always focus on payment, and that's where I try to get people. It's similar, Matt, when somebody calls me and says, my price point's $400,000. Mm-hmm. The question I always ask somebody is, well, where did you come up with that price point?
Right.
Okay. Well, I'm looking for a condo, and based on the math that I've done online, that looks like, okay, well, you could show me a $500,000 condo that is cheaper than a $400,000 condo just due to taxes and assessments.
Correct. Yeah.
So I try to always get people to not focus on purchase price and focus on payment and what they're comfortable spending.
So it's a big thing that Ben brings up with this. It's exactly what I tell my clients when I say, well, what's your budget? And they say 400,000.
Right.
And they say, well, I don't think I need to be approved because I got great credit. And I say, well, it's not about what your credit is. And it's not about what you want to spend. It's about what you can afford and what you want your payments to be. So take a breakdown, have them break it down for you, and explain this thing called closing costs. Have you heard of those? Those are
a little bit.
Those are big that people always tend
What do you mean?
to
They're always free.
Yeah.
You don't pay anything.
People tend to forget about closing costs. So I say you got to look at all your costs and you put it on paper, and it's a simple math problem. That's all it is. It just comes down to math problem. Now, I'm not the greatest at math. I'm not going to lie to you, but I can tell you a solution when I see that. And I say to myself and I say to my clients that look at the numbers and say you're comfortable with it, because the banks are always going to give you more than what you can afford, right? I mean, like you can
Usually,
so like your DTI can always be like high, but just because you can afford $5,000 a month payments, maybe you only want to spend $3,000.
Correct.
So then you do backwards math, right?
Correct.
Put it on a napkin and you back out. Okay, how do I get to $3,000? Then that's what my number should be. And you would say something like, hey, if it's $400,000, you need HOAs to be X amount and taxes to be X amount.
Correct.
Anything above that's going to change the numbers, right?
Yep.
So it's not that difficult. So when people talk about like, well, hey, these rates are going to kill the market, is what I hear, or prices are going to plummet. I tell people, well, listen, first off, the markets I work in, 50% of my markets have been the biggest buyer's market in my career. I would say it would be way easier to sell high rises during the Great Recession than they are today. Because during the Great Recession, I have to convince people that people wouldn't live in the city or go to offices. But the fact that a rate's going to go from 3.75 to 4.25 is going to have zero impact, because the fact is, pre-pandemic, rates were around what, 4.25, 4.5?
Yeah, I know, 4%, 4.25. You know, I tell everybody, and it's always a fine line that you got to be careful when you're talking to people. But at the end of the day, if a 0.25% swing,
What kind of fine line?
If a 0.25% swing in rate or a 0.5 point swing in rate is going to make or break your ability to buy a house, then you're spending too much money.
So,
I mean, that's really what it boils down to.
I agree. Now, when somebody complains about a rate to you, when you talk about the fine line, are you nice about it, or are you kind of like passive aggressive about it?
I'm very nice.
You're a very nice guy.
Calm, cool, and collected.
I would remove the passive the way I would be. I would just go right to aggressive.
Yeah.
So
that's why you and I get along so well.
Yeah. But I mean, I would say though, like, you guys have to understand that like rates, historically speaking, being around 7%, if we go up to probably in that 4 to 4.25 range, which is probably what we're going to see, maybe people who are spending crazy prices in the suburbs where a place is worth, let's say, 800,000 and people are willing to go to 900, we'll probably see markets like that kind of get affected. But for the people who watch us and the markets that we work, when the places are worth 400,000, they're selling for 390. It's not really going to have an effect on our marketplace. Places that are super, super inflated, when you have rates kind of bump up a little bit, may affect some people's affordability because people are overpaying by so much. But most of our markets right now, people are paying market or maybe slightly above market. And that's what's going to be.
But it doesn't even, you talk about those markets. So keep in mind, I lend in every city and state in the union, right?
Yeah.
So you've got the markets like California, Florida, Texas, Colorado, Arizona. You've got people paying 20% over the price of the house, right?
Yeah.
They're not worried about their monthly payment. They're worried about the appraisal.
Yeah.
Why are they worried about the appraisal? Because
it's not worth it.
Now if it doesn't appraise, people have a much harder time coming up with cash than they do their payment going up $100 a month. And that's the barrier to entry for a lot of people in this crazy market. Not specifically Chicago, but, everywhere else where.
But I mean, like in those markets, I mean, first off, I don't know what everybody, I missed the job fair boat for that, where everybody's just like a billionaire in like California, Florida, and Texas. Everybody's got $2 million cash. I didn't know so many, multimillionaires existed in like these states, but everybody's a multimillionaire in those states. But, to me, where I see the concern, I don't know if I'd use the terminology bubble, but you've lived through the Great Recession. I lived through the Great Recession. I remember when it was like 2007, something would sell. Like, man, that sold for that. Man, that sold for that. Like, how is that possible? And then when the bubble hit and then 9, 10, 11, 12 hit, and, the media told everybody that nobody ever owned in America again, and we were bit once, people would say, well, I can't believe they paid for that. And you would be like, well, you didn't understand what was going on at the time. I'm seeing the same trends in a lot of these states. Like, I mean, I think it's crazy. I personally don't think that numbers like that can prop up. I also don't think that, like, the world's meant to have every single American have $2 million cash in the bank account either.
Correct.
I just don't think so.
I mean, but there's a fundamental difference between, 8, 9, and 10 relative today, right? When back then you could get a mortgage with a credit score and a heartbeat optional.
Right.
Okay. Now it is difficult to get I don't want to say difficult. You have to be qualified to get a loan. There's no ifs, ands, or buts. There's no lie about your income, lie about your assets. It is show me everything, and we're going to determine what you qualify for. So,
but my point is that, like, yes, whether you could qualify or not qualify for it, but like the stock market has been so strong. The job market has been so strong, and that if you look at historically speaking what happens just in the economy, it's not always like this. It goes like this, it goes like this. It goes up and down. I just think right now we're seeing a lot of fictitious money being thrown around because, again, the fact that there are so many, we're talking like hundreds of thousands of $2 million cash offers going out there. Like, I don't know where all the money's coming from.
I ask myself that every day. I've never seen people with more cash.
And then one guy's like a beekeeper, and then the other girl is something else. And they're buying these NFTs, which we talked about, the cryptos and stuff. I mean, when people got too much money, when people are spending $3 million on a non-fungible token online. I'm just saying, like, you want to talk about, there's a lot of problems in the world going on. People are spending, hundreds of millions of dollars on digital advertising that is just for themselves to show their friends.
I mean, you've got influencers making $5 million a year on TikTok or Instagram.
Right.
I mean, it's crazy.
So like when we talk about this compared to rates, like to me, it's like when we talk about a 3.75 to 4%, you got $2 million on the bank account. It's not really having some sort of impact.
It's all psychological for people.
100%.
It's all psychological.
What do you think that like the rising interest rates have on the housing market? Do you think that could help create a crash in the housing market? Like we're talking about the market's going up.
So obviously there's a threshold to that number.
Yeah.
When you've seen rates, January 3rd rates were 3%.
Yeah.
Call it rates are 4% 2 months later.
Yeah.
I have seen no impact on the housing market. Applications are up from a purchase standpoint. From a lending standpoint, refinance applications are obviously dramatically lower because if you didn't refinance in the last 2 years, you either didn't qualify or you've been living under a tree, quite honestly. So, I mean, our applications are up pretty substantially from this time last year when rates were significantly lower.
Yeah.
I think what's going to have a bigger impact on home prices, and you tell me, is supply and demand. I mean, that's the issue you see all over the country. You've got one house that comes on the market, you have 17 offers on it.
Right.
I mean, that to me, once the inventory becomes a lot more viable, I think that's going to have an impact on housing prices because everybody always wants to know, Ben, I don't want to buy in this crazy market. I don't want to overpay for my home, but I also don't want to miss out on my interest rate, as an example. It's like, listen, here's what's going to happen. Home prices will eventually stabilize or come down, and then your rate's going to go from 3 to 4 to 5. So you're paying for it one way or the other.
Right.
I mean, that's just the reality
you're
of the
overpaying
situation.
on the price, or you're paying high on the interest rate.
Exactly.
That's why I say interest rates in my mind are always fictitious. Because remember when the interest rates were 8%,
you
could put money in a CD and get like 4 or 5% back.
Correct.
Like right now they're like 0.2. Or, you know, you could put money in a savings account. And they were like 3 or 4% just in a savings account.
Zero.
So like the point is, like, unfortunately, if you do have money, like, you just lose money in one part, but make more money in a different part. Like, that's just how it is. So I hate to be the bearer of bad news on this, but what you bring up, the point is that when we talk about these inflated markets and what's happening, I keep telling people big cities have been getting pretty much demolished, like high rises in the city, you know, but the suburbs are doing so well. The only reason the suburbs are doing so well is because only 25% of people are in offices right now, pretty much across the country, okay? That number's going to grow. I mean, for us, the mask just came off, and I don't know about you, but I feel like the world's like a happier place here. I see more people smiling. I've never seen more people out in the streets. It's been 3 days. I mean, this is going to air probably a couple of weeks from now, but I mean, it's like a different planet. I'm walking into stores and like everybody's like high-fiving. It's like a different world, you know? But guess what? That's going to be contagious. That's going to bring more people back here. And when you take 3.5 million people and you go like this, all the other surrounding areas like, holy shit, how am I going to put up with all these people? And at some point, when this comes back to this, that's going to change. I mean, you got areas like Barrington, Hinsdale. I remember I had friends buying houses in Hinsdale in 2018 and 19 about around $2 million. And the average market time out there was like 300 and something days.
Oh, it's crazy.
They could do whatever they wanted. Today, if a $2 million house goes on the market, it sells in 10 seconds.
Yeah.
We put a $2 million house on the market down here. Good luck if you sell it. Like, good luck. I mean, like, you know, I know somebody
and
out there.
why is that?
It's because like you have 4 types of people that haven't existed, right? You have the first-time buyer market is just coming back this year.
Yep.
The out-of-state buyers, you know, people in Ohio, Indiana, stuff like that are buying second homes. Haven't been buying here because they've been buying cabins in the woods because they're like, you know, we got to be secluded. But now we're starting to see that market come back. Third person is the empty nesters, people who are cashing out and not coming to cities. I mean, obviously cities have had crime and, you know, problems with people like, you know, businesses and restaurants not open. That's coming back. And the fourth buyer, which doesn't exist yet, which I'm convinced is going to happen soon. I was wrong with saying we'd be back in the fourth quarter, but international market. Yeah. International sales make up about 20% of high-rise sales. I mean, that's been unheard of. And people in China, India, Middle East, and Russia, I hate to bring it up, but have been cashing out in America's stock market for forever. And they want to launder money to America. In fact, finally the news is talking about how much money's laundering from international sales just the last couple of days. And I've been talking about this forever. I said, what do you think, who buys these $5 million homes and nobody ever lives into it? It's international laundering money. That's all it is. It's washing cash. That's why whenever I get an international loan, just so you know, like somebody, I send the other agent just a picture of a laundromat. No, a laundromat. And because they go, this guy's like good for it. I'm like, here's this. And they go, what's that? I'm like, I know what he's doing. Like, I'm not an idiot. But I'm saying like those markets haven't existed and now they're starting to come back. But guess what? That's going to take away from the suburbs. So when we talk about interest rates and inflation and all this other stuff, it's just like a weird cycle we're in right now. And like, yeah, the rate's going to go up. But it's going to maybe soften these markets that are so over appreciated in the last couple of years. You know? I mean, you said you sell in Florida, right?
I mean, there's 1,000 people a day moving to Florida right now.
Okay, and the market, you know, a lot of realtors took their business down there.
100%.
And they say that the market is up 100% in the last 24 months. Yeah. Like, that doesn't make any sense. Guys, during the Great Recession, I remember this because I was just getting into the business, figuring out. I remember my dad telling me, like, yeah, I got this doctor client. He bought a $5 million penthouse in Miami, and today it's worth $800,000. And you're like, well, how is that possible? We'd be like, well, it went up so much. And now I'm like, there's the old saying, I keep telling people, history repeats itself. It's like when these prices go up so much, it's just artificial. I personally don't believe it can last. I just don't think so. And I'm not saying we're going to have this huge housing crash where the world's going to fucking end like it did during the Great Recession, but I do think that we're going to see certain markets become a lot softer than they were. A house isn't meant to go on the market day one in like Orland Park where I grew up, and it's never happened before, even in 05. House comes to market day one and there's 17 offers on it. Yeah. It's just not natural. It doesn't make any sense. I know. So when we talk about rates and people tell me how these rates can affect the market, I'm like, I don't think, maybe hopefully rates will help slow it down. You know, if anything, it should. Yeah. It's like an emergency brake. We need to kind of like pump the brakes a little bit before this gets out of control. And that's when we run into real problems. What about when we talk about, you know, the rates and all these different, you know, environments? Like, do people try different options? Do we go like a 7-year arm or a 10-year arm instead?
It depends. I mean, you know, people's risk tolerance is different. So some people are comfortable with arms, some people aren't. You know,
what is an arm, by the way? Just so we can explain it.
I don't know. Can you tell me actually?
Yeah, it's an adjustable
never heard of it.
mortgage.
Oh, thank you.
Okay.
Yeah,
so
awesome.
I only take out arms for the record. Okay.
Great. So do I.
Yeah. I get a low rate.
Why? Because people don't hold their mortgages, statistically speaking, for more than 3 to 7 years.
Yeah.
I mean, take right now as a perfect example.
Yeah.
You've got guys that are sitting on rates, call it, let's just say they timed the market perfectly in 2020 or early
Yeah.
2021 and they got a 2.75 rate,
Yeah.
okay, on a 30-year mortgage. I believe you will never see that rate ever again.
Right.
I don't know. I'm not the Fed. I don't have
Right.
a degree in economics.
Get it.
Okay. Now you've got their home up 25, 30, 40%, and now they want to take a bunch of cash out because they want to take that cash and they want to go buy something else. So, yeah, you get this mortgage, you get your 30-year, you think you're going to stay. First of all, who stays in their home 30 years? Not many people these days.
Not anymore.
So, that's also why I'm not, listen, when the spread between a fixed rate and an ARM is nominal, you're going to gravitate towards an ARM or a fixed rate.
100%.
Right? When you see that yield curve widen out a little bit, which is what happens, and ARM rates are 1% lower than a 30-year fix, ARMs become a little bit more popular because, again, people don't, when you buy in the city as a first-time home buyer, it's not your forever home.
Right.
You might keep it as a rental, and that's why you do a 30-year over an ARM. But, for the most part, everybody's appetite is different. I think most people aren't educated on how ARMs work, and they think the crash that happened back in 2009 was because people did ARMs, which is 100% not the case.
It had like almost nothing to do with it.
It had nothing to do with it.
I do exactly what you do. I look at what, I own quite a bit of real estate. I look at a 30-year fix. I mean, if it's an investment, a lot of times I do 30 if the rate's right. But if it's a 10, I'm going to pay it off anyways, right? I look at like, hey, if it's let's say 3.75 for a 30-year and it's 2.75 for like a 7, I'm going to do the 7. Like I'll take that % off and I'll figure it out or pay it off if I got to do something if shit hits the fan.
Or you'll refinance it.
100%. And maybe it's 6%, hypothetically, it's something crazy. But guess what? Like I still saved all that money for that 7 years of where it could have been over that %. So it's, again, I hate to keep bringing it up, but it just comes down to a simple math problem. You take a look at the math and you say, what do I save a month? And maybe you're saving $2,000 a month over 7 years, right? So you do that math and you'd be like, okay, well, let's say year 7 comes and it's a 6% rate, and I may have to hold this because generally cycles last 5 years. What's the difference in those 5 years? And you do the math problem, and you back it out, and there you go. That's how you determine what's a smarter move.
But people also, when they do ARMs, they don't typically stay in their ARMs for the life of the
No,
ARM.
They sell it. I'm just saying, like, shit hits the fan. Yeah.
Or you call me in a year and say, I'm in a 7-year ARM, and what are rates at? And can I get the same rate or something close to it? And I'll just refinance my mortgage and extend out the term.
How much does it cost for somebody to refinance on average?
In Chicago, $2,500. It's nothing. We're lucky.
It's actually like a 2 or 3 month payment, maybe. Or interest off your payment.
I mean, we are so fortunate that we live in a state where it's relatively nominal cost to refinance, where you look at places like New York, Florida, Texas, place where you don't pay state income tax. They get you on places like mortgage tax or transfer tax.
I mean, I'll tell you right now, I would take that all day long not to pay state income tax. But I'm just saying, in general, like, like
but
there's.
They get it everywhere.
Well, I always tell people that, like, the grass isn't always greener, because when you add up a cost here, a cost there, a cost there, like, maybe, depending on what you make a year, it may not make as much sense as we always brag about, like, with no state income tax. When you see these athletes go to different places, like, no state income tax. Like, well, what else are they spending the money on?
Right.
So, but I mean, when we talk about these rates and stuff like that, when it comes into, you brought up the refinancing, I have a personal theory, and I want to hear what you think about this, but, like, there's a lot of people who made their living, a lot of companies sprouted up really fast. I mean, how many more mortgage companies have you heard of in the last couple of years than there was before?
Maybe 1 billion.
Okay. Because, like, everybody I run into is now starting a mortgage company and branching off, right?
Correct.
It's like when real estate's really well, everybody starts a company, and then when it gets bad, they crash.
Correct.
Well, I read a statistic. I don't know how true this is, so I don't want to be quoted on this, but I read that about, like, 50% of mortgage companies' profits came from refis. Okay? So what happens when the refis go away to, like, these smaller companies that built a business off refis?
They're done.
So do you think the mortgage company, you're going to see a lot of people go out of business because of this refi?
Yes.
How many businesses would you say?
I don't know. A lot. I mean, I love a rising rate environment because it gets rid of all the people that shouldn't be doing what they're doing, quite honestly.
Yeah.
It's easy to sell a refinance.
Yeah.
Hey, here's your rate and here's your savings and here's what it's going to cost you, and sign on the dotted line.
Yeah.
Purchases, there's a lot much more emotion involved. There's more parties involved. It's just a more complicated process than a refinance.
I don't know if you're allowed to comment on this, but do you guys see your guys' own company having, like, maybe get rid of extra help you brought in for the refinances?
I mean, in the mortgage industry in general, that's just how it works.
Yeah.
You know, it goes, you hire, and sometimes you have to reduce staff because at the end of the day, you know, profitability obviously is important and all that
Right.
stuff. So yeah, I mean, you're seeing that a lot. You know, it's all these online lenders, right, that just thrive in the refinance
Yeah,
business.
we won't name any names.
Yeah.
But some of them are probably not as good as others, I'd say.
No, I mean, you know, I don't compete with the online lenders.
Right.
That is not the type of borrower that I'm going after. I'm not, you know, I want to actually physically speak to someone. I'm just not going to do it over email, because when you do it over email, things get lost in translation.
100%.
Nobody has a full understanding. Then they get to the closing and they're all pissed off. Well, you didn't say this and you didn't say this.
Right.
Well, yeah, that's because you didn't give us the opportunity to
Right.
get on the phone and talk.
Right.
That's why I always tell everybody, you know, if there's an issue or there is something that goes sideways, you either weren't listening to me, or I didn't do my job correctly.
Yeah.
And usually it's the former.
That you didn't do your job correctly.
Yeah, exactly.
But so like, I mean, and when he brings up the online rates, I mean, I know a lot of our clients shop on like the bigger online rates. And I always say, like, when we get offers from people, I try not to accept them. Now, I legally can't not accept them, but I like to try to get other people approved, because these online lenders, they pump out these approvals like candy.
Yes.
And they give out these fictitious rates, and
Yes.
then they get locked in. And here we are under contract, let's say at 400,000 through something XYZ loan depot something, you know, and then it comes back, and then they find out the rate's actually 1% higher, and then we get a kill letter, and then we get fired from our sellers. It's just like, well, how didn't you predict this? I'm like, well, I'm only as good as the information given to me. You know what I mean? So like, it's important that people actually talk to people, know what they're doing, to understand like what a real rate is and how they actually come up with it, because there's different rates for single families and condos,
Yes.
and there's different rates, I believe, for condos and investment properties, right?
Correct. And second homes.
Yeah.
You know, second homes, Fannie and Freddie, who issue all the mortgages, we all know, they've
Yeah.
put, you know, price adjustments in on second homes now.
Right.
You know, as long as I've been doing this, primary residence and second home rates have typically been almost identical.
Yeah.
Second home rates are half a point higher now.
Yeah. Just, and
You
they
know,
can.
They can, because Fannie and Freddie control the market, and they're the one who
Right.
issue all the funds, and, you know, that's the story.
Now, when we talk about like all these different rates and, you know,
Yeah.
these online banks and stuff like that, how many of your clients have you been getting like lately that are like really complaining about this? So like, is it been like like harder to get these people pre-approved because of it, or is it like, do you feel like you're getting shopped more than ever?
Oh yeah, I mean, we're totally commodity driven.
Yeah.
Because people go online and they see a rate that doesn't exist.
Yeah. So they go on these online things and then you lose them.
I tell everybody, if I'm telling you a rate's 3.75%,
Yeah.
go look on the internet. I'm sure you'll see a rate advertised at 3%. I see it all the time on my Instagram
Right.
feed or any of my social media stuff. I
Yeah.
mean, it's absolutely fascinating to me why people do that.
Right.
You're just setting people up for disappointment.
Right. So if you, let's say you talk to 5 people on the phone
Yeah.
about approvals, how many of those will you end up converting or losing? Let's say, how many of those would you lose because of like fictitious online interest rates that they see?
I would tell you that my pull-through rate is extremely high. It
Okay.
just takes more time helping them understand what
Yeah.
the difference is. I mean, think about it. At the end of the day, Matt, you're calling me for a mortgage. No, somebody's not a 0.5% better in a rate than I am. It's
Right.
not possible
I
unless
agree.
it's apples and oranges.
Right.
So at the end of the day, if that's what somebody sees, I would encourage them to go get it in detail.
Right.
Get your loan estimate. Figure out what your rate is. What are they charging you? I mean, that is the most, when you see rising rates, what happens is you'll see a lot of lenders start quoting lower rates and charging a lot more money.
So like
Because at
back
the-
end fees.
Yeah, points.
So how do you figure out if they're charging you points?
I can tell just by the rate they're being quoted, and then
Yeah.
you get the documentation to support it.
Yeah.
So anytime somebody's, well, Ben, they're a 0.25% lower than you are, okay, get the documentation and show it to me.
Right.
Right? Then we get the documentation, and now all of a sudden you see kind of the devil's always in the detail.
Right.
You know, at the end of the day, that's just the way it works, because what does a consumer understand when they get a mortgage?
Yeah.
Their rate.
Yeah.
Most of them don't pay attention to the costs.
Right.
Until it's too late. They get all the documentation and they're
Right.
like, wait a minute, I'm paying $6,000 to get this mortgage when I should be paying $1,500, which
Right.
is kind of the standard
Right.
when you get a mortgage. You shouldn't spend more than $1,500 to get a mortgage.
So how could somebody, when they're getting these fictitious approvers or anything like that, and they just ask for a rate, what would be a question that they should ask? Like, what's the back end fee?
Rates and costs.
So like all in cost.
You know, because everybody also says, well, I'm getting a $5,000 credit at closing.
Yeah.
Okay, well, what are they charging you?
Yeah.
Okay, I can tell you I'm giving you $10,000 credit at closing, and I'm charging you $11,000 in fees.
Right.
You know, people just hear what they want to hear, but they don't understand the detail. So that's why I tell you purchases are a lot more difficult than refinances.
Yeah.
Because at the end of the day, people hear what they want to hear and they believe what they want to believe.
Correct.
And they make a bad decision.
Yeah.
That's why, you know, you and I do so well, and that's why you encourage everybody to work with me, because number one, you know we'll close a deal, and number one, we'll treat them with, you know, we're not going to overpromise and underdeliver. I just don't do that.
Yeah, that's the biggest problem that we run into is the day of close, specifically with a lot of these online ones. They get the closing costs and like, why is this triple what we thought it was going to be? And I was like, well, I don't, you know, that's a question. That's not I didn't charge anything.
Correct.
You know, as a buyer, it doesn't cost anything to use an agent technically, you know? So, you know, there's these back end fees. So you guys got to pay attention to those. But when it boils down to, when we talk about these rising rates, everybody, you just have to know is that like, it's going to change your monthly payments a little bit, but it's not going to massively have a huge impact on the actual market. So while we leave this, what are 3 things that you think you should tell consumers to know about with rising interest rates? Do you have any tidbits you would have them look at? Maybe check out fees on the back end as one.
What's the question?
Like, what are 3 things people should know about when it comes to rising rates? Like questions that people should be asking.
Well, I think number one, everybody needs to understand their budget.
Understand budget?
Know, you'd be surprised when people call me and you refer me, you know, Joe Smith, right?
Yeah.
And Joe Smith says, hey, well, I'm looking between 400 and $1 million.
Yeah.
That's a pretty substantial difference, right?
It's a big budget. Yeah.
A lot of people do that, okay? And my immediate question, you know, I always believe that you should get pre-approved for whatever you think your max budget is.
Right.
If I can approve you for $1 million, I can approve you for 400,000.
Right.
It's pretty straightforward. So I tell everybody, you know, one of the first questions when somebody calls me and says, look, I'm looking to get pre-approved. Okay, have you thought about a price point? Have you thought about a down payment?
Right.
No. Okay, well, let's talk about that. I have no idea what my price point is. Okay, well then how I get it out of them is I say, okay, let's back into this. What do you have available for a down payment?
Yeah.
I have 50 grand available for a down payment. Okay, great. Where do you want your monthly payment to be? I want my payment to be $3,000 a month. Okay, now I know you're probably going to be in that $450,000 to $500,000 price point, right? So, but everybody always wants to know what their maximum is, right?
Yeah.
It's obviously a great thing to be qualified
Yeah.
for a lot more than you're comfortable spending.
Right.
That's the best scenario you can be in.
So it's kind of like you know, I always tell people you got to be approved first because you want to know what your budget is, understand what your payments are, and then lastly, understand what your fees are going to be. And at the end of the day, a rate is just a subjective object that's going to constantly change throughout all of our lives, and it's just something you have to live with. But it doesn't. There's no historical data of showing it like drastically like brings the property values plummeting it down.
No.
Even it was like 18%. You know, so
you know, when people talk about property values, it's like, listen, if you're thinking about buying this home and selling in 2 years, don't buy a house.
right.
I mean, I don't care how good or bad the market is. You're
Right.
going to lose.
Right.
You know that.
Right.
You
Just
know,
with
you've
fees
got
alone.
costs, fees, all
Yeah.
that stuff. You're going to lose.
Yeah.
So at the end of the day, you know, everybody's so afraid to like get that pre-approval. I don't want my credit run. I don't want this. I don't want that. I mean,
Yeah.
just at the end of the day, if you don't understand what your budget is, you don't understand what your payments are, you don't understand rates, you don't understand fees, how can you go out and plan strategically and logistically
Right.
for what you want to do or not do? Especially in this market, you
Yeah.
have to be ready to execute. When a home comes on the market,
Yeah.
you've got to be ready to rock. That's just the way
100%.
it works. So, you know, encouraging people to get pre-approved, I mean, that's the most important thing. You can never get pre-approved too early. I don't care if you buy a house tomorrow
Yep.
or you buy a house in 2 years.
Yeah.
You know, I tell everybody, once you get pre-approved, you're going to feel so much better because you're going to understand what you can or can't do.
Exactly.
You know, especially right now when you've got to potentially buy before you sell.
Right.
You know?
Which is a big problem right now.
Yeah. Can you qualify to
Right.
do that? And then if you can, are you comfortable doing that?
Right.
You know, that's the biggest thing we deal with. Ben, I'm 100% selling before I buy.
Okay.
Well, okay, Matt, what if you go out tomorrow and you find your dream home?
Right.
Then what happens?
Right.
So how about we qualify you and we determine if you can actually buy without selling?
Right.
And if you can, then it's your executive decision. If you can't, then don't waste your time, because I tell everyone, if you're going to start looking at houses, you're going to find something way quicker than you ever thought. How many times do you hear that?
All
I'm
the
looking
time.
to buy a house in the summer. All of a sudden, a week from now, they call you and be like, I just found a house and you won't believe
Right.
it.
Once you start walking into places, you know, and you're on the mindset that you want to buy, like,
Yeah.
people are going to buy. It's just how it is. If you're mentally ready to buy, it doesn't matter how far out you are. It just takes one walkthrough to be like, this checks the boxes.
That's why I appreciate how you run your business so much, because at the end of the day, you don't want to drive somebody all around town until you know they've got their financing in order. Not only do they have their financing in order, are they looking at the right price point? I don't want to show you $1 million condos if you're not comfortable with what a $1 million condo costs you.
Well, that's what it all boils down to. I tell people is that the reason why your friends say it was a terrible experience or was it a good experience is the fact that how prepared were you? And mentally, if you get the payments down and you're mentally prepared to know this is what it's going to cost me, you'll feel a lot better. The problem is somebody sees something for $1 million, they love it, then they look at the payments, they're like, oh shit, I thought my credit was better, or I didn't know I missed a payment on a car a long time ago. Now it prevents me from being approved. Now I'm only up to $700,000. And now they're frustrated. And what do? We never blame ourselves. We're Americans. We always blame everybody else for our problems, right? So now you're an asshole, I'm an asshole, and everybody else is, and we're never buying again. And that's just how it goes. So that's why it's so important to get approved up front, but also understanding that, right now I feel like the easy thing that people are using for the market is, well, I think these rates are what's going to bring us down. So we can't always use excuses. It's like you said, we got to look at payments and how it's going to affect it and do backwards math from there.
I mean, take the last 48 hours as a perfect example.
There's been a lot going on.
Right?
Yeah.
Rates started, I don't want to say crashing, but rates have been going up and up and up and up since January 3rd.
Yeah.
Okay. Literally every single day, up and up and up.
Yeah.
Then all this stuff happens, in Russia and Ukraine. Rates come down a quarter point.
Yeah.
What happens? Greed kicks in. Oh, Ben, I think they're going to keep going down.
Right.
Now they're just going to go back down. What happens this morning? You get a super strong jobs report.
Right.
You've got, Powell who spoke this morning.
Yeah.
And now I'm getting alert to lock. Now rates are going right back up. I mean, it's unbelievable. You can't, I tell everybody, like, don't chase an interest rate. You can't time a purchase around what you think a rate is going to be or what it's not going to be.
Well, if we could predict the rate, we would also be able to predict the stock market, which we probably wouldn't be doing this.
If I could predict mortgage rates, I can promise you I would never be selling mortgages ever again.
So I tell people all the time, whenever like a deal dies and people start yelling at me, like, listen, if I could predict this deal dying, like, and I could predict all that stuff, I had mind control. I wouldn't be selling real estate right now. Okay?
Exactly.
So, all right, guys. Well, that's all we got for the rising rates. Ben, how can people find you?
You can find me at ben@rate.com is my email. 312-339-5533. You can always go on our website to guaranteedrate.com and find me. That's pretty much it. Google me, Yelp me, Amazon me. I'm all over the board.
Are you on
Instagram.
Amazon?
Yeah. Reviews. Amazon's a big review these days.
Okay.
Everywhere.
Okay.
Online reviews. Yeah. Everybody cares about the online reviews these days.
I'm a big review guy myself.
So we try to, anytime you get a positive feedback from a survey, we try to get people to go online and,
fill it out.
Because that's what the millennials like, right? They're all about the online these days.
That's what it is. So, all right, guys. Well, thanks for listening to Laricy Live.
Thanks, Ben. Oh, thanks, ladies.